Welcome to PIMCO Pod. In this episode, we discuss how markets may be pricing some relief for now, but the true measure of an oil shock is how long it endures. Stay tuned after the conclusion of the podcast for additional important information. The Credit Market Lens: Oil Supply Shocks Don't Age Well, by Lofty Karui. The Middle East ceasefire sparked a relief rally last week as markets dialed back the risk of a deep, drawn-out oil supply shock. Stocks have already erased the post-conflict drop. Bonds haven't gotten the memo. Yields are still elevated, keeping a bit of extra-term premium on the table. That gap is telling. Bond investors are still pricing a messier growth inflation mix than the pre-conflict baseline, and crude isn't exactly flashing all clear either, with spot prices still near $100 a barrel as of this writing. History is blunt on this point. It's not the oil spike that breaks risk appetite, it's how long it sticks around. By comparing cumulative changes in spot and 6-month crude futures across the 4 major oil supply shocks of the past 4 decades, the 1990 Gulf War, the 2000 OPEC production cuts, the 2022 Russia-Ukraine conflict, and the current Middle East war. Just over a month into the current episode, both spot and 6-month futures have tracked a path remarkably similar to the early phase of the 1990 Gulf War. The bottom line is that it was only as the 1990 conflict dragged on, energy infrastructure was taken offline and excess inventories depleted, that markets began to sharply reprice longer-dated oil futures. That inflection coincided with material widening of U.S. dollar investment-grade credit spreads and lower Treasury yields, as investors increasingly treated the shock as a negative impulse for economic growth. Whether the current episode follows a similar trajectory remains uncertain, but if it does, time is not your friend. A potentially deeper K-shaped divide. The K-shaped economy narrative has regained momentum as higher gas prices weigh more heavily on lower-income U.S. households than on others. As of year-end 2025, data from the Federal Reserve Bank of New York show credit card and auto loan delinquencies near 2-decade highs, despite low unemployment and healthy aggregate metrics such as debt service and debt-to-income ratios. Lower-income households have largely exhausted excess savings and remain disproportionately exposed to elevated prices for essentials such as rent, insurance, and healthcare, while higher interest rates have raised debt servicing costs and tightened access to credit. The result is a bifurcated consumer: resilience at the top of the income spectrum and growing stress at the bottom. Nowhere is this more apparent than in the auto loan market, where asset-backed securities, ABS data, indicate that the rise in delinquencies has been driven almost entirely by subprime borrowers. At the start of the year, consensus economic expectations centered on stronger growth, easing inflation, and lower monetary policy rates, helping to relieve pressure on subprime borrowers. The current backdrop challenges that narrative, leaving lower-income households even more exposed. The bifurcation does not mean higher-income U.S. households are fully insulated from an economic slowdown. Here again, data from the Federal Reserve Board show that the combined value of household real estate equity and equity shares, a measure of household wealth tied to the housing and stock markets, has increased roughly 4-fold since the end of the global financial crisis, far outpacing nominal GDP. To put this in context, as a share of nominal GDP, the value of household real estate equity and equity share has risen from about 120% at year-end 2009 to roughly 271% as of year-end 2025, the highest level on record. This strong reliance on asset-based wealth creates its own vulnerabilities. Abrupt tightening in financial conditions, particularly via lower stock market prices, could trigger larger wealth effects than in the past, which could ultimately lead to weaker consumption and aggregate demand. Securitized products: strong buffers, sharper fault lines. Despite the continued deterioration in fundamentals among lower-income households, the ABS market appears largely unfazed. At face value, spreads in benchmark ABS have shown little to no movement year to date. Does that signal complacency? Not necessarily. The strong credit enhancement levels in senior ABS tranches, those highest in the capital structure, remain exceptionally robust, providing substantial buffer against underlying credit stress. That said, the primary market, where new deals are sold, is beginning to reveal a more nuanced picture. There, a clear bifurcation has emerged between prime and subprime collateral, with investors demanding greater compensation for lower quality exposure. The implication is straightforward. While headline spreads may appear stable, dispersion is likely to increase under the surface. In this environment, staying higher up in the capital structure and focusing on quality remain key. Thank you for listening. That was The Credit Market Lens. Oil supply shocks don't age well. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.